Taz Ellett. I'm with the Bishop Realtor Group, and at this time I want to welcome our team from the Bishop Realtor Group. So if you're with the Bishop Realtor Group, if you would, just stand. And on the back table there. So grateful to have them here, and it's wonderful to be a part of that team. On your tables also, you'll see the green tickets. This is for a door prize. And we're going to be giving some giveaways. If you would, go ahead and just fill that out. Leave it on your table right there if you would. And then we'll have folks that will pick that up sometime during the presentation. Your name and everything will get in the basket, and we'll have a drawing at that time. As far as the rest of today goes, there's another group that we're partnering with. And I'm going to turn the mic over to that group, and this is Reagan Bates, and he is the VP here in mortgage, assistant VP in mortgage department with AMNAT, and he's going to introduce his team, and then we'll come right back.
Thanks, Taz. As he said, my name is Reagan Bates. I'm with the mortgage department here at American National Bank and Trust. We have a lot of great speakers from Bishop and American National here to give some knowledge and education. Our first one, Ashton Gustafson, broker owner of Bishop Realtor Group. Following that, it's going to be Mark Vattenheimer, Senior Vice President of Commercial Lending with American National Bank and Trust. Following Mark will be Michael Boyle, Senior Vice President, Trust and Investments with American National Bank and Trust. And then lastly, and he had told me he may throw in some jokes at the end for some comedy. I don't know if that's true or not, or maybe I'm just making this up and putting him on the spot. But Zach Beck, President of American National Title of Texas. Taz, back to you.
Might be easier just to do this for just a little bit, but I guess if I had kind of one wish, and I'm serious as I can be about this, I would want Ashton Gustafson to write a book. Yeah, I would want him to write a book, and without a doubt, the forward of that book would have to be by Denny and Ann Bishop, who they're all mentors of mine, and the reason why we have that building right next door that the Bishop team gathers around is for them, and so we're really excited to welcome Ashton here in just a bit, and then just give a shout out to Ann and Denny for their leadership with the Bishop Group, what they have started, what they have built, and where we are now, but also leaders in this community, just wonderful people. I'm grateful to be a part of that. Ashton is a mentor, and I do want you to write that book, buddy, without a doubt, because that's one I would read. Ashton, appreciate you being here.
Okay,
Thank you.
for having me. All right. Last time I saw a microphone set up like this was like Twitter photos of Maria Maloney in Las Vegas. We were talking about that. Thank you all for having us. It is border
Thank you, Ashton. Can you hear me without the microphone? No. Huh? No? All right, fine. I'll use the microphone. Thank you, everybody, for being here. I'm certainly not the professional speaker that Ashton is, so bear with me here. I have my notes, and slides don't match up very well with my notes, but I'm also glad that Ashton covered in detail some of the topics that I'm like, how can I get through all this stuff in a short period of time? But since he went in depth on some of these things, some of this stuff is going to be regurgitated. I didn't know what he was going to speak about. He didn't know what I was doing. So anyway, kind of what I titled my thing is property investment. Is this a right thing for me? And this is kind of investment 101. So if you're experienced in this may get a little bit on the boring side for you. But I started out with what are the initial considerations? And I think the first one is, what is your investment goal? What are you trying to do? Are you trying to build wealth? Are you trying to maintain your current wealth and just looking to diversify what you currently have? You don't want all your money in a 401k or an IRA. You'd like to have some in real estate property. Are you trying to build a nest egg? Are you looking for that mailbox money? And that's kind of a term that you probably all heard, but basically it's once you retire, you go out to the mailbox because that rent check is in the mailbox every month, or you hope that it's in the mailbox every month. Or are you looking to sell it at retirement? I'm from Windthorst, more of a farming community. Those guys down there, they invest in tractors and cows and farmland and whatever, and whenever they retire, the way they get their money is you start liquidating those assets. Nearly, I can't say nearly nobody, but most of the people that I worked with when I banked in Windthorst, they didn't know what a 401k or an IRA even was. That's just not what they do. So, theirs is build up equity in their operation, where this idea is, are you trying to build up this nest egg in investment properties? And then also maybe you just, you got plenty of money, you're just looking for something to pass on to your kids or your grandkids or whatever. So it really, you need to evaluate, what are my investment goals? How diverse do I want to be? So then the next thing is capital. And Ashton touched on this, and it takes a lot of cash. It does. If you have a lot of cash, you're good to go. You can go do whatever you want to do. But most people don't have a lot of cash. But these are considerations to take into mind, that if you're like, this is something I'd really like to do, this is what I want to get into, well, maybe you start diverting that money that you've been setting back in your 401k and your IRAs, and you start stashing that cash so you have money to be able to make the down payment, to be able to, whenever figure out that you can afford to do the maintenance, the backing into the garage door or the repairs, the upkeep. Property taxes in Texas, they're high. I mean, whenever I talk to people from other states, they're going, holy cow, how can you afford to buy investment property in Texas? Your property taxes are too high. Keep in mind, this last year, your home mortgage, you get a $100,000 deduction. No such thing on investment property. You pay taxes on the full amount of the value of the property. So it is expensive. And insurance, anybody who owns a home knows what has happened to insurance in the last couple of years. It's gone sky high. And so you need to take all that into consideration. And then a big thing a bank looks at is, beyond all that, how much additional cash do you have in reserve just in case the air conditioner goes out or whatever. So then the next consideration that I would consider is time and talent. And he touched on this already. Is, well, how actively involved do you want to be in the day-to-day operations? Do you have the talent to be able to do your own repairs and make-readies? That's not me. I don't have that ability. I mean, I've already thought about this, and I'm like, if I do this, I've got to do it with my son-in-law, because he can do and fix anything and everything. It would have to be something like that for me, because I don't want to mess with advertising. I don't want to find renters or have to worry about collection. I could do the bookkeeping, but how actively involved do you want to be? Or again, like Ashton talked about, you hire someone to do that. It certainly cuts into your profit margins, and again, backpacking on, it usually takes several properties. Most places probably aren't going to be interested in managing a single property for you, but once you get multiple doors, that may be something that, that you might want to consider. And then what's the property type that you want? Are you looking for a single family residence? Are you looking at, multifamily like duplexes, triplexes, small apartments. Are you looking at the bigger stuff? You want to strip centers or storage units. I put Tractor Supply and T-Mobile because I know that's a couple of places that do leasehold agreements. Someone owns that property. Those opportunities are there, probably more for people that have significant volumes of cash. Same thing with office complexes, and I have to throw in my ag side with the farmland, ag acreage. I mean, there's a lot of people that buy farmland, and I tell people all the time, and even if they don't use it, God only created so much dirt, and he's not creating any more dirt. So to me, every day that goes by, that dirt is worth a little bit more today than what it was yesterday. So next thing is, how would I want to structure this? If I'm going to do this, how do I want to structure it? Do I just want to put it in my individual name? You could do a partnership. It could be your spouse. It could be another investor. It could be kind of like I talked about with me and my son-in-law. I would be the money man and he would be the handyman. Or maybe it's the other way around. Maybe you're the handyman, you don't have the money, but somebody's got money and you can go into a partnership. Of course, you're splitting revenues then, but it's an option. Or an LLC, a limited liability company, which Ashton talked on that pretty good. Yes, we kind of recommend too, that's a good way to go, especially if you have a lot of other personal assets, because it protects your personal assets. Whereas if you go out and you buy 10, 15, 20 real estate properties that are all in your individual name, someone come and sues you, they can get anything you got. But if it's in a LLC, they're limited as to how much they can get. It's also a structured, one of the advantages is that an LLC is structured. It has a company agreement, tells you what you can and can't do, who can do it. There is paperwork involved. Another advantage is filing of a tax return. I mean, it doesn't cost a whole lot of money, but you might be able to file that as part of your regular tax return, so you're not talking about like a total separate set of books. Just file it as a Schedule C. And also LLCs, it's just taxed as regular income. Any money that maybe you make, it's not taxed on the corporate level, and then again on your individual level. Disadvantages, there's a little bit of a startup cost. It's a good time to get an attorney involved. You might have to have two tax returns. The other thing touched on is, if you're in an LLC, you can't borrow from a mortgage company. If you borrow it in your own individual name, you can go see Brad or Reagan or one of those guys, and you can borrow that money as an individual. You can get that long-term lower fixed rate, but you're accepting the liability. What gets expensive is that you're limited as to how many of those you can do. Is it 10 or 10 at a time or something like that? And once you get 10, you may go, man, I got a lot of stuff out here. I really probably ought to be looking at putting this into an LLC. Now you got the big expense of moving 10 properties into an LLC. So it's a consideration to take into account. And then what's your risk tolerance? I mean, there's no guarantees you're going to make money on this stuff. There can be a loss of your initial investment. It can be loss of other capital. If you default on your loan at the bank, we're gonna sue you, or they're gonna sue you. I hope I don't have to sue you, but maybe they would. So then, what's your first step? And Ashton touched on it. You want to build your resource team. You want to find out. Who do I need? Well, you're going to need a banker, and that banker is going to want some stuff from you. You need to decide who that is. It's a good idea to talk to them early. What kind of property do you want? Maybe you have a specific address that you're interested in. He's going to want to know, do you have enough down payment money? Typically, you're going to be looking at 25 to 35%, sometimes more. These are typically shorter amortization loans, which is really better for you because the faster you get it paid off, the quicker you can go buy you more property. What's the cash flow from the property? Realtors are great to help you with market analysis. What kind of rent can I get on this property? Like I say, if you're stuck in a dilapidated part of town, rent's probably going to be pretty low. You might buy that property pretty cheap, but rent's going to be pretty low. Bottom line is, what's the bottom line? And you need to take all of that into consideration. Sometimes that rent, especially depending upon the amortization, it's not going to cover your principal, interest, taxes, and insurance. So do you have other sources of revenue a day job or whatever it is, what kind of liquid reserves do you have? Your banker's going to want your legal documents if it's an LLC. He's going to want your financials, personal and business, financial statements, tax returns. So it's a good idea just to go, if you have a banker or if it's one of us or whatever, you all just sit down with them and have the conversation that says, what do I need? What do I looking at? This is what I have. What can I afford? And then you can go back to the next person, which is your realtor, and go, hey, look, this is kind of what I need is a property that's in this price range and whatever, and let them be the experts on helping you find what it is that you need. And this goes on a lot. I've got a couple of clients here in town that do that very thing. They have realtors that are out looking for properties that match their description, and then going back and go, hey, I found this property. They look at it, hey, yeah, that works, do it. Yeah, no, that's not for me. Let's do something else. So, use a realtor because, like I say, that's not my expertise. I did actually have an interesting phone call. This was right at the end of COVID, and it was someone from Spokane, Washington. And they called and they said, hey, I'm in contract to buy a house in Wichita Falls. I got a great deal on it. It's only $275,000, and what's your down payment? What's your structure and stuff? And I'm telling them all that stuff. And I said, we do them on 5-year balloons. He goes, he said, I'll have it paid off in less than 5 years. He said, this house is going to rent for $9,000 a month. And I said, I don't think we're interested in doing business with you. He may have had all kinds of money. He might have been able to pay it off. He might have been paid cash. I don't know, but I don't want to deal with somebody that is so clueless about what goes on around here. So again, deal with realtors. Use a little bit of common sense. You can certainly buy direct. I mean, we have a lot of people, they look for repos, they look for house that grandma passed away and they don't want to mess with, they just want somebody else to take it, and it's kind of a fast, cheap deal. Everything has its own little sets of challenges. So again, just visit with your banker first before you sign anything, or get something lined up in advance. Rehab houses and flips, not really American National things. There may be people in town that do them. Although I've done some, but it's not secured with that house that has a hole in the roof. It's secured with something else that will loan you the money on that, so you can go buy that and you can fix it up. So there's ways to get around that stuff. Next part of your resource team needs to be your CPA. Ashton's already touched on that. It's an important thing to have. An attorney, sure, it's going to cost some money, but in the end, he's probably going to save you money. And keep in mind the Small Business Development Center at Midwestern. They're a great resource for people of any kind, anybody trying to get into any kind of new business, whether it's investing in this, you want to open a restaurant, you want to do anything. It's they are a great source. So then it gets down to it's decision time. These are the things you need to think about. Do I have it? Am I ready? And then you decide, is real estate investing, is this right for me? Are we ready to proceed, or do I need another couple years of stash and cash? What do I want to invest in? Personally, I love triplexes and duplexes. I mean, they're usually in one unit. You got 3 rentals coming out of one property. Sometimes it's even like a house that was divided in half, and it's got a front and a back, and they put a building in the back. So you got 3 rental incomes coming in off of one property. Those are kind of my personal preferences. But anyway, there's lots of properties for sale, and I didn't know there was that many, but there's a lot of them, but not all of them will make good investment properties. So you have to evaluate each one. That's where your realtor, will really help you come in mind. But some of it just takes math. You got to sit down and figure out what, will this thing cash flow? And if it doesn't, can I make up the cash flow? So is real estate investment, is that the right thing for you? I can't answer that question. You're going to have to decide that on your own. So anyway, thank you very much. Next up, Mr. Michael Boyle from our trust department, American National Bank and Trust.
Thank you. I'll try to be judicious with my time so we can get to Zach's jokes. I know we don't have a whole lot of time here. I'm here to speak today on 1031 exchanges. I don't know how many of y'all are familiar with those. Basically, 1031 refers to the IRS code, or excuse me, Internal Revenue Code, Section 1031. It was based off of somebody challenged the Internal Revenue Code many years ago. His name was Starker in California. Basically said if he was going to sell a property and reinvest that money into another property, since he wasn't getting the benefit of that cash, he shouldn't have to pay taxes on it. He challenged the Internal Revenue, the IRS, and won, and that was the birthplace of the 1031 exchanges. So just going into what is a 1031 exchange, can everybody hear me okay? Because I kind of talk with my hands, so the mic might be moving around. Basically, it's a tax deferment strategy, and just like I was saying, it allows you to take the profits from a sale of one property and reinvest into another property, and thus deferring your capital gains taxes on that property. You can go from one property into multiple properties. You can go from multiple properties into one. It's a very flexible. It is called like-kind exchanges. So a lot of people, a lot of the questions I get on that is, okay, I'm selling a rent house. Do I have to buy a rent house? Can I buy a business property? It's very flexible. That is a very broad term. So we'll kind of get into that a little bit more. Again, there's no limit on the number of properties that you can buy. The other nice thing to say, it's a tax deferment strategy. It can also be a tax avoidance strategy because there's no limit on the number of times you can do this. So you can have your original property, buy another property, hold it for 5 or 6 years, sell it, make a gain, buy another property. You can keep doing this until St. Peter comes and calls you away. And then at that point in time, your heirs can inherit those properties. They get to step up in basis, and therefore you haven't paid taxes on any of those properties that you've sold over those time. So it's going to be really helpful. So what are the requirements of a 1031 exchange? A couple of things. It does have to be like kind. Basically, that's, again, is pretty broad. When you're talking about like kind, there's a couple of rules in the section, the code that talks about it. Basically, it has to be something that is held for investment purposes, or it has to be used in a trade or a business. So what does that not include? It does not include your personal residence, okay? That's probably the biggest thing that we get, and also vacation homes. Vacation homes is kind of a gray area, and we can kind of get into it. You can do it, you can use it, but there's a very little minimal use that you can have of it before you disqualify yourself. The other thing you want to remember is you want to trade into greater or equal or up is basically the easiest way to say it. A lot of times I get people who are selling a property, they've got a huge gain on it, they have a low basis in it, they've heard of a 1031 exchange, they're selling, say, a $500,000 house, they want to go buy a $200,000 house. Okay? I'm going to throw numbers out there, and this is where I really confuse people. But if you had a $200,000 cost basis in that, okay, if you were to sell that outright, you'd have a $300,000 gain, right? So if you're going to sell this and you're going to go buy a $200,000 property, always remember your basis stays with your property. So that $200,000 basis you had goes into your new property at $200,000. You're not saving any taxes because that $300,000 that you're putting in your pocket, you're going to get taxed 100% on it. If you have questions of that, I'm not going to get too far in the weeds, but if you have questions about that afterwards, come see me. We can talk about the specifics on that. There are some holding period requirements. So this is properties held for investment purposes. What that doesn't include is fix and flips. So if you buy a house, fix it, and try to sell it again, that doesn't qualify. You have to hold it for investment purposes. The IRS generally has defined that as at least holding it for 2 years. Some people will say 2 tax cycles. Kind of depends on which CPA you're talking to. But a general rule is that you have to hold that for 2 years before you sell it and 2 years after you sell it. Okay? We already talked about no personal residence and vacation home issues we'll talk about in a little bit. The last requirement is the same taxpayer. So you're deferring taxes on that property, so it has to stay with the same tax owner. It has to be the same title. So if it was in your name individually, it's got to be in your name individually on the new property. Okay? If it's an LLC that owned the original property, that same LLC has to buy the replacement property. Okay? We get into some issues, and if we have time, I'll get into them today. But with those LLC issues and stuff like that, if you've got, say, 2 members of the LLC and one of them wants to cash out, you've got to be real careful about doing that when you're doing a 1031 exchange, because if one of the partners or one of the members of that LLC walks away with cash, they can basically say that you didn't hold that for the investment period. So again, kind of think about that 2-year rule. It really takes some planning. If you've got some members of an LLC or a partnership that want to take their money out, really you got to kind of coordinate that around when you're going to 1031 exchange so you don't foul up your exchange. All right, so what are like-kind properties? Again, this is very broad. You can have a single-family dwelling into multifamily dwelling. You can do the opposite. You can do raw land for a mall, office building for farmlands. These are all just examples. So just basically telling you that there isn't really, like-kind does not mean apples to apples. It means you can go from single-family to multifamily. You can go to one property to multiple. The only issues you really got to get into is it an investment property or was it used in a trade or business? Okay. Important timelines. So this is probably the area that gets people probably the most heartache when they're trying to do a 1031 exchange. You've got the basically two that you've got to really remember are your 45-day deadline. So what that 45-day deadline means is when you go into, so I didn't skip that, okay, making sure it's on the right slide. When you go into contract on selling your existing property, okay, once you close on that, okay, so once you go into the title company and actually close on that property, you have 45 days from that day to identify potential replacement properties, okay? There's a couple different rules on what you can identify, but basically, and I think I have that in another slide, you have to identify what you may potentially purchase within that 45 days, okay? And what those rules are, there's 3 rules, and I may be skipping ahead of the slide, and if so, we can just gloss over it when I get to it. Basically, there's 3 rules that you can look at when you're identifying a property. So you can have what's called the 3 property rule, which basically means that in your 45-day notice, you can identify 3 properties regardless of value, okay? And you can close on any one of those 3 properties, okay? Or any combination of those 3 properties. Same thing with the 200% rule, is you can name as many properties as you want, as long as they're not twice what you sold. So if you're selling 300,000, you can name properties up to 600,000. And again, close on any combination of those, okay? The last one's the 95% rule. You don't see that very often. Basically what that is whatever you identify, you have to close on 95% of it. That's really hard to do unless you have a whole lot of properties. Most times when you see that is when you have mineral leases and stuff like that is where you get into that scenario. Okay, 180-day deadline. So again, from that day you close on your original property, you've got a total of 180 days to actually acquire the properties that you identified within the 45 days, okay? Again, those times run concurrently, so it's not 180 days after the 45th day. They both start at the date of closing, okay? Boot issues, I kind of talked about this a little bit when I was giving you my scenario of the $500,000 house, but you want to trade equal or up. Any cash you get out of the deal is going to be taxable to you. It's called cash boot or taxable boot. The other thing to remember, and this is what I have to do a lot of education on people when they call me, is, well, I only got $10,000 in cash. Well, yes, but you paid off a $200,000 note, okay? So mortgage boot or mortgage relief is also considered stuff that you have to replace. So if you paid off a $200,000 note and got $20,000 in cash, that's $220,000 that you need to reinvest, okay? So use another example. I have somebody who had a $300,000 property, let's say, to split it in thirds. Let's say they had a $100,000 note and they get $200,000 in cash, okay? A lot of people will come and say, well, I've just got $200,000 in cash. That's what I need to reinvest. No, you also paid off the note of $100,000, so you have to invest for $300,000. Now you can replace that with new debt. Mortgage debt out and in offset each other, but you just have to remember that that total number is what has to be replaced, okay? Stages of an exchange. Basically, once you decide you want to do a 1031 exchange or you think you want to do a 1031 exchange, you basically call someone like us. Somebody's going to help you facilitate a 1031 exchange. You don't have to do it before you enter a contract. You just have to talk to us before you close on that contract, okay? It typically takes us about a week. We can get it done within a week. But the earlier, the better. That way, if we run into any kind of issues, we can identify those. Basically, what your exchange facilitator is going to need on the front end is a copy of the contract. They're going to need to know exactly who is selling the property, again, whether it's the LLC, whether it's your individual name. They'll get documents drawn up. Normally, if there's safe harbor, there is some safe harbor in the Internal Revenue Code that most QIs will follow. They'll get that information, then we'll reach out to your title company. We're going to have you sign a couple of exchange documents, and then basically what happens is that contract gets assigned to your exchange, okay? So if it's Michael Boyle and I'm selling a property, I decide I'm going to do a 1031 exchange. I'm going to contact a QI. I'm going to set up my exchange. So now let's say it's AmNat AmNet Exchange Services is who's going to do the exchange or who's going to be my QI. So that contract will no longer say it's being sold by Michael Boyle. It'll say that it's being sold by AmNet Exchange Services, qualified intermediary for Michael Boyle. Okay, so that's important because, again, like we talked about, anytime you touch cash, then it becomes taxable, or you can kind of torch your exchange. So all the funds from your sale has to go into your exchange. Okay, so they'll sign that settlement statement on your behalf. You still sign it as interested party. You're still involved all the way through, but just for the mechanics of it, it goes. The contract has been assigned to the QI. Those funds then go into an account for your benefit, held exclusively for your benefit, for you to acquire your replacement purchase. And I'm getting the time, Keisha, so I'm going to move on. Let's see here. And then basically from that, once you identify your replacement properties, again with the same rules we've already talked about, then we'll close that property on your benefit. Let's go on. We're going to skip. We've already talked about identification requirement. I went over the three property rule, 200% rule. Types of exchanges. Don't really need to get into this. It's in your slide, but if you have it, it kind of just defines what the different types of exchanges are. Most of them, what you're going to see is a delayed exchange where you sell the property on the front end and then buy another property on the back end. You can do it in reverse, where you buy your replacement property first. Just tell you right now, it's more complicated and it's more expensive. Basically what happens is you have to form another company or an LLC that's going to hold that property until you have time to sell your replacement property. And just also keep in mind that same time requirements are involved on a reverse exchange. The other stuff is really just kind of education, and I'll leave it in there for you, but it's ownership issues. Again, we talked about it a little bit already, just the LLCs, it's got to be in the same name, going in, coming out. Related party issues, that is another one that come up a lot. You can do it. The only thing the IRS doesn't like is if you have related parties doing an exchange. They don't like it where somebody who's doing the exchange, a related party member, ends up with cash. So if you're doing it and you're exchanging with a family member, as long as they're doing an exchange too, you're pretty good. So where you can sell a property to a related party, and buy from an unrelated party. Properties and parties, I can't say. You are fine. But it's when you're acquiring from your related party. I'm just going to give up. A related party is when you have issues. Other thing I will say on this is it can be complicated, and I'm kind of running out of time, so I won't get anything else. But if you do have questions, please come see me afterwards. I'd be happy to talk to you about it. But one thing I will say about 1031s is it can be complicated. There are obviously a lot of tax implications in there. You've got depreciation recapture issues that you got to think about. There's a lot of different items to think about. So if you are thinking about doing one of these, just like Ashton and Mark said, talk to your professionals, talk to your CPAs, make sure it's a good situation for you. And then once you've done that, come see us and we'll be glad to help you. I'll be here afterwards if you've got particular questions. I thank you for your time. And now we'll turn it over to comedian Zach.
Thanks, Michael. I don't have a joke. I don't know where that came from. I was on a Zoom call yesterday, and I made a joke, and everyone said I wasn't remotely funny. So there's y'all's joke. So we're going to talk about business entities in Texas. The two things I can say, and they've been echoed. I'm going to echo what they've already said. Get an accountant, get an attorney. The two biggest advice I can give, have both of those in your corner. Because there are several ways to hold property in Texas. We're going to talk about 5 of the most general ones. There are other ones, but the 5 that we see the most, and just a couple of reasons why. Let's see. So why you'd hold title in Texas in a business entity? First, be for personal liability avoidance. It's kind of self-explanatory there, to help protect you. If somebody, who knows, if you have a pool in your rental property and they drowned, you don't want to get sued for it. It needs to be in your LLC. Second would be for privacy purposes. Not everybody wants to know who owns every property, and it kind of, if you're in an LLC, it kind of can shield you from, who actually owns the property and things like that. You can find out, but it does help out a little bit. And also it provides for a framework of good for decision-making purposes. So if you say you're with a partner and you want to, have some ground rules of when you would sell and things like that for the business, That will help you, give you a game plan that y'all started from the beginning before y'all had multiple properties. And then the lastly, and probably the most important part, is the potential tax benefits. That's another thing. You want to talk with your CPA on those things to see how do you want to file your tax return. Like Mark said, you can put on Schedule C of your individual return, or you can do an 1120, 1065 if you're a corporation, just whatever you want to do, talk with your CPA on those things. So next slide, please. We'll talk about the 5 different entities that we most commonly see. The most common is going to be the LLC, limited liability company. And then you're also kind of in conjunction together. You could have general partnerships and limited partnerships, corporations, bigger companies. If you're going to do, multiple properties, and then joint ventures. That's going to be for more of the individual, maybe 1 or 2 offs, and we'll discuss those a little bit further down. So for your LLCs, next slide. So this can be LLCs can be either member only or with managers. And so with a member only, you've got whoever, you can have just a single sole member LLC who runs the whole company, or it can be with multiple members and they can be run by managers. Things like this, you want to talk to your attorney. This is going to be your attorney to help you out. What's the best way to run based upon your plan for investing? And then with the LLC as well, you can get different kind of tax treatments, whether you do it as a partnership or you do it on a corporate tax treatment. That's where you're going to get the CPA. This is just to give you a broad idea of the different choices you have, but you definitely want to talk to those guys to see what's right for you and what type of investment you're going into. And then also talk about with judgments for the LLC. So judgments against individual members and managers do not attach to the property. So if you have a partner and he goes sideways, it's not going to attach to y'all's joint property together. And then from the title company, the things that we're looking at is whenever you go to sell, whenever you go to buy those properties, go to finance, you've got to have some certain things that you want to make sure you can keep up with. One being organized by the Secretary of State. So if you're an LLC, you need to be registered with the Secretary of State. You'll need to stay in good standing. That involves filing your franchise tax returns or making sure there's nothing due, which your CPA will help you with on those things. And then also having your articles of organization and operating agreements and a resolution. And that's just going to say, hey, if me and Bob over here, we're in a partnership together, I can sign on behalf of the LLC, he can sign, we both have to sign. Those things are going to be key to make sure you keep that paperwork whenever you go to sell, purchase, finance, whatever you're doing with your property. Next slide. So talking about general partnerships, this is going to be in conjunction with the next one, the limited partnerships. So I'm going to kind of talk about them all together. A general partnership is an association of 2 or more parties to carry out a business. It is the most flexible, but the owners have the most liability. So if you're not really going to see somebody buying a property just in a general partner. So the general partner usually act on behalf of a limited partnership. And so also most general partners are LLCs. They're not going to be a sole person. So an LLC can be the general partner for a limited partner. It's kind of confusing. I know even saying it sounds confusing, but that's where your attorney's going to get y'all set up to make sure you're doing what's best for you. And same thing, we'll go to the next slide for conveyance. You're going to have a written agreement again. That's key. General partners do not have to be registered with the Secretary of State. And then most your general partner is going to sign at closing. And so we'll go to the next slide, talk about limited partnerships. So a limited partnership will be 1 or more general partners or 1 or more limited partners. The general partner of the limited partnership maintains the day-to-day operations. And so they're going to be the ones who kind of make the choices of, fixing the air conditioner for rental properties, if it's a strip mall, taking care of all the rents, things like that. And then the general partner has the unlimited liability of all the debts, obligations, and responsibilities of the limited partnerships. So making the limited partner is not liable for all those issues. And then also, as we've talked about with everything else, on the next slide is you'll have to have the limited partnership agreement, make sure everything's in writing, the who is who and who can sign out on what. This one has to be registered with the Secretary of State, so you need to make sure you stay in good standing. And then also have that partnership resolution that outlines the rules between all the partners. And the next slide we'll talk about corporations. So this is a complete separate and distinct business entity. So corporations are owned by the shareholders. You're going to be managed by your board of directors, and it's operated by the officers. So if you look at the bank, for example, it's a corporation. You've got the board of directors that kind of set the broad overview of the bank. It sets your officers. They run the bank. And the shareholders own the bank, essentially. They elect the directors, and then the officers run the bank. Same thing. So in a bigger corporation, that's what you're going to want to do. If you're buying rental properties, corporation's probably not going to be the best, best choice for you. However, with the corporation, it could be a C corp, S corp. Those are things your CPA is going to want to, talk with those guys about for which tax benefits you the most. And then same thing, if you do have a corporation and you're selling property, you will have to have a resolution authorized by the board of directors that says you can sell the property and who can sign on behalf of the corporation. And then the last one, it's not quite as common, but it's kind of depending on what you want to do. So if you just want to go out and buy one rental property with a partner, a joint venture might be the best choice for you. It's just agreement between two more parties formed to purchase that one. It's kind of a one-off here, a one-off there. Maybe this is just a little side hustle you want to have. The joint venture may be the best choice for you because it doesn't require as much. You're not going to go with the Secretary of State. You don't have to have all those things. You still want to have a joint venture agreement, but whenever you go to finance or purchase, sell, both of you are going to sign out anyway because you're equally involved. You'll see this with spouses. If a husband and wife want to go buy a few rental properties, this may be the best choice for them. But all in all, you want to talk with your banker, with your realtor, with your CPA, your attorney, to see what's your plan, what do you want to do, and then these are some just broad overview choices of ways to kind of go out, skinning that cat. And that's all I've got. No more jokes. And here's Taz with the Bishop Group.
All right. Well, I think getting back to Ashton's book that he's going to write for me one day to read and for all of us to read. I think he would say that probably, or at least I hope that steeped all the way through that would be the theme of partnership. And to think about who we partner with, Brad and your team, and Zach and your team, but then also it's who we serve. Those who are y'all, the clients. And so we really appreciate the opportunity to serve you. We want to be a resource for you in the market and to be able to answer any questions that you might have. And while they're gathering up the tickets, we're going to have a winner here in just a little bit. But for the sake of time, and where are we on our time? It's time. So what we want to do is let you know that our speakers will be around to answer any questions that you might have. We were hoping to maybe have an open forum time, but we want to respect your time as well. So with that, I think we're about to draw support local here. Maria, you want to tell us about what that is real quick?